This is question time at Alhambra Investments, patterned after question time in the Parliament in Britain. We get different questions, though. And so today, Steve Brennan's going to tell us what's up on deck for Joe.
Sure, Joe. Question today is, we've said the S&P 500 is as much as 43% overvalued. How do we get to a percentage that precise?
Well, we're not trying to be precise. We're trying to be provocative. Well, no, come on. I'll just tell you how we look at valuation. And let me preface this by saying valuation is a crummy market timing tool, by the way. Evaluation of markets and stocks tells you about risk. It does not tell you about the short-term reward, because things that are overvalued can get more overvalued, and things that are undervalued can get more undervalued. I will say that we are not big believers in the efficient market hypothesis around here, though. So how do we get there? How do we get to this 43% number, 43% overvalued? Well, let's look at what's called the Fed model. The Fed model of valuing the stock market. And look, this is not an official Fed model. It's something that came out of the Fed. Somebody wrote a paper about it, and people call it the Fed model. But here's what it is. All you do is you take a look at the 10-year Treasury note yield, and you compare it to the S&P 500 earnings yield, which yields our first question, which is, what the heck is an earnings yield? Everybody knows what price to earnings ratio is. It's pretty easy. Take the price, divide it by the earnings. That's your price to earnings ratio. Well, an earnings yield is just a reciprocal of that. Take the earnings and divide it by the price. And the theory there is, suppose you could pay out all of your earnings as a dividend. What would the yield be? Okay, so we're going to take that earnings yield and compare it to a 10-year Treasury note. Well, the only problem with that is the 10-year Treasury note has no credit risk. And of course, that's not true of the S&P 500. It does have credit risk. In fact, the average credit rating in the S&P 500 for the companies in the S&P 500 is a BBB. Now, I will tell you that is that's a completely different topic, but it tells you too about the quality of, I think, of the S&P 500 these days, in that the average credit rating is one step above junk. But regardless, there are some very high quality companies in there. But let's talk about the valuation. So what we said was, well, if the S&P 500 is BBB, then maybe we should be looking at BBB yields and not Treasury yields. And so that's what we do. We take a look at a variety of things. When we're thinking about valuations, we think about things in a variety of ways. We think of, what is the BBB yield? What is the earnings yield in the S&P 500? We also look at credit spreads. How tight is the BBB to the Treasury? If it's very wide, that might change the way you view this valuation methodology. And when would it be wide? It would be wide during recession, when earnings are going to be depressed. And so that's a situation where, using this method, it would look overvalued even though you're in the middle of a recession, when it's probably not. So you have to be careful about how you use these things. It's a static thing. It's not dynamic, but on a static basis. So we also look at the earnings growth trend, because obviously the BBB bond, if you bought a 5-year BBB bond today, you get 5.73%. That's where the rate is right now. Say 5 3/4. But you know what you're going to get over the next 5 years. You're going to get 5 3/4. The earnings yield, on the other hand, of the S&P 500 is a moving target. Right? Today, you can look and say, here's what the earnings yield is, because we know what the earnings were, but we don't know what they're going to be in 5 years. So we look at all those things when we're thinking about valuation. So where are we right now? Well, you got that 5 3/4 from the BBB, and unfortunately, the S&P 500 earnings yield is about 4.1. And so obviously, with the earnings yield on the S&P 500 lower than that BBB bond, it's overvalued. And if you just do the numbers, it's 43%. Now, we wouldn't say it's actually 43% overvalued. We have lots of problems with the way the S&P 500 is structured. We think it's too concentrated in one area, lots of things, but it's not really 43% overvalued, I don't think. If you take into account earnings growth, now that doesn't say it's not overvalued, by the way. If you take into account earnings growth, you could say, well, look, if earnings are growing very rapidly, then maybe it makes sense. But unfortunately, earnings are not growing that rapidly. You did have a surge in earnings coming out of COVID in the last 3 quarters, actually, of 2020 and into 2021. Earnings went up about almost 70% from the lows. Well, that's just the recovery from very bad earnings during COVID. Since then, earnings growth has slowed considerably. And so year over year right now, S&P 500 earnings are up 7.7%. So again, it becomes kind of hard to justify a very high multiple on the S&P if you've got earnings growth of only 7%. But let's make an assumption. We do know that earnings are going to, well, we don't know. Right now, earnings estimates say, look, earnings are going to be up pretty good this year. I don't want to put an exact number on that, but roughly 15%, which is not a bad earnings growth. So what we do is we take a look at it and say, well, what is the long-term earnings growth of the S&P 500? Well, we've got data back to 1989, and actually we've got data a little further back than that, but there were some changes in the way these things are calculated over the years. So we go back to 1989, and the average is 6.6% a year. You think, wow, that's, maybe earnings were growing a lot slower back then. Well, maybe, but let's look at since 2000. Well, then it's actually a little bit less. It's about 6.5%, but that's not a significant difference. However, if we look from 2000 and after the great financial crisis, and we go from 2009, then the average is 10.4. So let's think about that. So what would happen if earnings grew at that 6.6% rate? Well, in that case, even if you grew earnings by 6.6% a year through 2028, the earnings yield would still be only 5.6%, which is still less than the triple B bond at 5.75. So rather than think about this in quantity, it's 43% overvalued. Think about it in terms of time. How long does it take earnings to catch up to where that triple B earnings or triple B yield is? Okay, so we know that even when we go 5 years out, we can't get there using the historical earnings growth rate. So let's use the one 10.4, the one since 2009, which, okay, I suppose it can keep growing that way for a while. But in the long run, these earnings are going to grow maybe a little bit better than nominal GDP. And nominal GDP over the long term grows at 4.5. So, and I say a little bit better because obviously these are the 500 largest companies and theoretically the 500 highest quality companies in the economy, but it's not the whole economy. Those earnings in the S&P 500 can grow faster than the economy. But let's take the 10.4. If we do that, we still have to go out 4 years to 2027 before we reach an earnings yield that's higher than the current triple B rating. So like I said, think about it in terms of time. I think is a better way to look at it. And I think when you do that, you're waiting a long time for these earnings to catch up to where the triple B yield is today. So look, we think the S&P 500 is overvalued. Now, I will tell you, it's interesting because if you weight the index differently, this is not every stock in the S&P 500 that's overvalued. If you weight it differently, if you look at an equal weight version, it's not overvalued. But on the way it's structured, market cap weighting, it is pretty highly valued and I think overvalued. Look, there's other ways to look at this too. You can look at Shiller Cape PE, which, by the way, is approaching the 2021 high and could be making a run for the 1999 high, which was over 40, which is kind of stunning. Like I said, there's lots of ways to value things. It's not a market timing tool. It tells you about risk. In this case, we think the risk of owning the S&P 500 is significant. And so we don't have it in our portfolios. We think if you want to take that kind of risk, it shouldn't be all of your equity exposure. Maybe it's a small piece of it. We don't even go that far. So anyway, it's overvalued. How much exactly is maybe up for debate, but I don't think there's much doubt that it is overvalued the way it's structured.
Do you have S&P 500 questions for Joe or any question at all? Be sure and put them in the comments section down below and we'll pass them on to Joe.